Good morning. Welcome to Tuesday's Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Vinny Motiwala. And today is a quiet session. After the over 1% rally that we had yesterday, today markets are consolidating, at least in the morning. Mid-cap action is intact. The mid-cap index is up 0.5%, and defense, that's the big star today. It rallied close to about 3-4% yesterday, and today it's followed it up with another 3% gain on expectation that government spending in the defense sector will continue to remain healthy and will continue to grow, which is why BEL is your top gainer in the Nifty pack. But outside of that, a Mazgaon Dock, HAL, Paras Defense, cutting across market capitalizations, all the defense stocks are buzzing high.
Hi, Reema. Good morning. So, yes, defense is a trend that we're seeing today as well. And other than that, auto ancillary names, they are too buzzing in trade. Updates coming in on the Trump tariff front is something that are keeping the auto anch names in focus today. Now, sector-wise, when you're looking at pharma is not managing to hold on to gains today. It's among down almost 0.5 to 0.6% in today's trading session. So, let's watch out for that. Some bit of a recovery that's coming, but pharma is surely down and out in trade. Other than that, we also have FMCG that's not managing to hold on to gains. So, that is something to watch out for. What's doing well, what's managing to hold on to the green, PSU banks and realty are among the top gainers in terms of sectors that we're watching out for. One stock that I do want to highlight as well, Whirlpool India, that's also buzzing in trade today, 3% uptick for Whirlpool India. There was some news article that came in from Economic Times, but yes, we're seeing Whirlpool, 9% uptick. In the last few minutes, it's seen a 3% uptick as well, so keep an eye out on that. So yes, Reema, that's how the market setup is looking like. An interesting day that's coming in, though not much in terms of a trading up move that we're seeing for the benchmark indices. But let's bring on board Varun Locha from HDFC Securities also, who's joining in with us to discuss the market fundamentals and his top sectoral picks as well. Varun, good morning. Thank you so much for joining in with us. In terms of the market, we are amidst the earnings season. So overall for the Indian markets, given the geopolitical situation as well as earnings, what are you watching out for, and what is the growth that you're expecting this earnings season?
Yeah, good morning. So earnings season this time around is largely on expected lines. We are expecting some more downgrades even in this quarter, largely led by IT and some of the global businesses, like global centric businesses. Domestics, again, domestic cyclicals are still not showing a very strong recovery. I think financials have started off well in terms of earnings season, so that out there we are seeing some marginal upgrades to our estimates. So net, we believe this year FY26 we are expecting around 12% earning growth, which is not, I would say, really strong, but better than last year. And there are still some marginal risk to the downside on the earning estimate, but I think the pace of downgrades is definitely reducing. So Q3 and Q2 had very sharp downgrades. Q4 would be a tad lower, and we expect by Q1 we'll be largely done with the downgrades.
Do you have you done the analysis so far in Q4? What's the upgrade-downgrade ratio looking like, or the percentage of overall downgrades? And where is it that we've seen maximum pain?
See, so far only 50 stocks out of our coverage of around 240 to 50 stocks have reported. So in that, as I said, financials have generally done better than what we were expecting, and IT, despite we cutting numbers in our preview itself, have seen further downgrades. So I would say, and cement has done better. So those are some of the pockets. Consumer is still on the weak side, but a lot of the numbers are yet to come. So net, I would say as of now, it would be even Stevens, like 50% in terms of upgrade, downgrade, with banking leading the upgrades and IT leading the downgrades.
Okay, banking leading the upgrades, IT leading the downgrades. But, right now, what sectors will you look at to buy also as of now? Financials, will that be something that you'll keep looking at? Or maybe, where you're seeing a bit of a correction, pharma, IT, that is also something that attracts you?
I think, the market are not, at a stage where you can expect a very high return at an aggregate level. So in that sense, a lot of frequent rotation will continue to happen even in FY26. That's our view, because valuations are really capping the upside at an aggregate level. At the same time, the downside also beyond 22,000 look unlikely unless we have some really major earnings cut event, either led by global developments or the domestic developments. But as of now, our We are not seeing a level below 22,000 either. So in that scenario, like, we have been having financials as one of our top picks for last 6 months. We were progressively adding that, and we were underweight IT. That has played out to a large extent. While we still continue to prefer financials over IT, but I think IT with the recent correction and financials with the 20% kind of an up move are now looking more balanced in our view. And if there is, say, some more financials rally, then we would be taking money off financials as well, because it's not that financials are going to have a very strong earning growth in FY26. So it's a sort of a range bound market with more rotations and frequent rotations across some of these sectors. Beyond these, I think pharma, as you said, we are still positive, but both IT and pharma, we had cut our weights because they were the only performing sectors last year when domestic cyclicals were under pressure. And in fact, we had added some exposure to domestic cyclicals, both industrials, real estate after the correction, and even consumer discretionary. So those are the other two pockets, some of the consumer discretionary and industrials, real estate sort of segment where we have added exposure. And IT, pharma, if they correct a bit more, we will be looking to add them back.
You said in financials, if they rally a bit more, you would look to trim your positions. So about a 5-10% rally from here on, and then you would look to unwind in which stocks? Which are the stocks that you hold right now where you think, which are prime for profit booking?
See, I think some of the large NBFCs, they have already done well, and now again valuations are starting to look full. Like, some of our, we had gotten quite positive on both Bajaj Finance and Chola. While we still have positive rating, we don't have much upside left on our target prices now in those two stocks. Similarly, some of the large private sector banks, while we continue to like ICICI, Axis and all, but I think the extent of upside left now is a tad limited. So even Kotak Bank, for that matter, the upside left now on our target price seems to be on the lesser side. So some of these would be the names where we would be willing to take profits if they rally further.
Okay. Varun, what is your thought coming in on the broader end of the markets? While you did say some of the sectors that you like and you listed out those sectors, but is it more on the large cap side in these sector names that you would look, or would it be more on the mid and small cap side?
I think mid and small cap this entire year, calendar year, we believe are going to underperform the large caps. Valuations are still on the higher side, especially in mid cap, not so much on small caps now, but small caps are anyway struggling for growth in this sort of an environment when neither the domestic growth nor the global growth is too supportive. So we are looking for more ideas in large cap because I think the margin of safety, even from a valuation perspective and resilience of growth perspective, is better in large caps. Mid and small cap, very selective. So some of the selective mid cap where we are quite confident on the medium term growth out there, we are looking to add on dips, but otherwise generally preferring large caps. We expect mid and small caps to continue to underperform this year.
Okay, and your thoughts coming in on the real estate side. Last 6 months, we've seen a bit of a correction coming in for these real estate names. Would you stay away from these names, or would you look to enter real estate right now?
No, so this is one of the sectors which we are looking to add in this correction because on the numbers we are quite confident that we'll continue to see robust residential sales even in FY26 and 27. We don't believe we are at the end of the rally, while obviously from COVID lows you have seen very high pre-sales growth for some of these developers. That will not continue. But still, it would be a healthy number and there would be a YOY growth. Valuations had gone through the roof 6 months back, but now with almost 30 to 50% correction in a lot of these names, some of them are looking attractive. So we see this more as a consumer discretionary segment where we are confident on medium-term growth and therefore looking to add some of the names in the recent correction.
What would you look to add, if at all, in IT? Would it be the ER&D companies which have fallen 35-40% from their recent highs? Would it be the IT services companies where the free cash flow yield is now looking attractive, but growth is missing? Where would your preference lie?
So for last 6 odd months, our preference was for large cap IT over mid cap IT because valuations were looking stretched out there. While mid cap IT, obviously some of the names have been doing exceedingly well in terms of growth. We believe the valuation premium they were enjoying is a bit on the higher side. So I would go with large cap IT where there is some valuation support of free cash flow yield coming in with this correction. Our first, sort of point of entry would be out there because we believe the growth rates, even for some of the mid-sized companies which have done exceedingly well, will also slow down in this environment, and therefore, it's better to have some margin of safety in valuations in this sector, given the sort of uncertainty we are in terms of the top line growth.
Varun, just the last word from me is what I want to understand in terms of overall macro indicators. When you look at some of the points coming in, industrial output, credit growth, some of the trends in terms of inflation seems to be like that the worst is behind. Is that the case? And for the rest of the year of FY26, what is the overall growth that one could expect or pencil in terms of earnings?
Yeah, so as our house view has been that the macros have definitely bottomed out. What we saw in Q2 in terms of the GDP growth and inflation at that point of time, they were probably the worst, and incrementally things are getting better. Be it growth, be it inflation, be it the interest rates, be it the RBI sort of stance in terms of providing liquidity and cutting interest rates. So therefore, the downside to the market is limited, but at the same time, the upside, because we are still not in a high growth environment. Our GDP growth this year would be close to 6.3. Next year will not be substantially higher. So in that sense, earning growth, as I said at the beginning, would be, right now we are penciling in around 12%. And if you ask me, the chances of it becoming 10% are higher than chances of it going to 15, 16%. So therefore, your upside gets capped. The moment you have a 10% kind of a rally, the way we had in April itself, your upside start getting capped. At the same time, the downside, the 22,000 level, we have seen that a lot of stocks start getting attractive once they come around those levels. So I think it's going to be a range bound market for another 6 months before we either, by that time, if we remain range bound, then valuations will become even more comfortable, and growth we believe will incrementally pick up more in second half of FY26.
Okay, markets range bound for the next 6 months. 22,000 is a hold. Is perhaps the bottom for the markets in the near term. Thank you, Varun, for joining in. We'll get into a break. On the other side, we'll talk commodities. Manisha Gupta joins in on the other side.
Hello, welcome back to Trading Hour on CNBC-TV18. A quick look at what the market is doing as of now in terms of broader end of the market, managing to hold on to that gain. Advance decline ratio as of now is in the favor of advances versus decline is what we're seeing. Nifty mid-cap holding on to gains of 0.5%. Look at the ratio as well as of now. Advance decline ratio, 1,621 stocks in the advance versus 865. But yes, market setup looking, managing to hold on to gains, so not much to complain on that front. But what's happening in the world of commodities? We have Manisha joining in with us to tell us what is she focusing on this morning and what should we keep an eye out on. Good morning, Manisha.
Morning, and thank you for that, Vinny. I'm looking at copper prices, which have seen a decline of around 4% for the month of April. Well, the month of April clearly has been a very volatile year when it comes to copper prices. For the year, of course, we are up by nearly 22% right now. But as I was saying, we saw all-time highs in the US markets when it came to copper. Well, this was all ahead of the tariff that came unleashing around and an expectation that you could be looking at some tariff concerns concerns coming in for copper as well. So for the US markets, we saw a 3-month lows at around $4.03, and then we saw an all-time high of around $5.27 a pound as well. So that's the kind of range that we've seen into the markets. As far as LME is concerned, while we did see very sharp declines there, but for the month of April, we are still up by 15% from the kind of lows that we saw. Having said that, this month is getting into negative when it comes to copper prices there. Well, to depend upon, China has increased its copper production, managing demand as well. And then there's uncertainty about, as I said, on copper being included in the trade barriers there. If you look at the Chinese copper inventories, well, we have seen a record weekly drop coming in for this one. And the Shanghai inventories have declined by 50% in the past 1 month on strong opportunity buying by the physical players there. Chinese demand has been quite resilient. We do understand that the downstream companies are creating stocks as well. And then China also has started to come out with various stimulus measures and expectation of more going forward to boost consumption, and that perhaps could be supportive. The other important news coming in from Russia is that they are also increasing production of gold and copper going forward, because whether it comes about traditional ways of copper consumption or the new generative and energy transition ways of copper, you are looking at higher demand going forward. So markets believe that whatever decline that we had to see in copper perhaps has been done for the month of April, and from here on you could be looking at buying opportunities for this one.
Thank you very much for that. Get into a break. On the other side, market technicals lined up with Mitesh Thakkar. He'll also give us a few trading bets. Welcome back. It's going to be a big earnings day today. So you've got BPCL, Trent, Bajaj Finance. For Bajaj Finance, apart from numbers, the company will also deliberate on a stock split and a bonus share issue, and lots of interesting mid-cap companies like IndiaMart. IndiaMart post the Q3 numbers, and the disappointment has fallen close to about 8 to 10%. So whether there is a recovery in IndiaMart will also be tracked very closely. So big earnings day today. But let's welcome, as promised, Mitesh on the show. Mitesh, quiet so far. So how would you approach trade? What's the strategy and your stock picks?
So, good morning. One, I think, I was highlighting that try and take profits once we get closer to 24, 455 zone. I think we've kind of retreated from there. This market to me still looks like we possibly do some kind of sideways consolidation with 24,000, 23,850 as the lower end and 24, 455 as the upper end of the range. So next 2 days, I think, traders should be slightly agile and nimble in booking profits as we approach the upper end of the range. On the stock side, I have a buy on Siemens. I think that's a stock which is breaking out today. Buy here with the stop just below levels of 29.30 and look for a target of 30.60 on the upside. And BEL is also having a good price volume breakout action. So buy here with the stop at 310 for targets of 330.
Okay. Shorty, thank you so much for that. We'll keep an eye out on those stocks as well as the levels in the market as well. But let's move on. An IndusInd Bank has announced that its Deputy CEO, Arun Khurana, has resigned with immediate effect weeks after the private lender disclosed accounting lapses in its derivatives portfolio. Ritu is here to give us more details on this one.
Well, thanks for that. In what is clearly a fallout of the accounting discrepancies in IndusInd Bank's derivatives portfolio, Deputy CEO Arun Khurana has resigned with immediate effect as of yesterday. As we'd reported a couple of weeks ago, this was likely because Khurana was overseeing the Treasury Front Office, which is the division responsible for the derivatives portfolio, where incorrect accounting had led to a near 2,000 crore rupee hit on the bank's P&L. In his resignation letter as well, Arun Khurana has cited the recent unfortunate developments linked to the discrepancies and this P&L hit as the key reason for his decision. Now, this resignation comes just a day after the bank disclosed that an independent investigation had identified the key individuals who were responsible, and the bank had stated that the board will determine changes and realign senior management responsibilities based on the report's findings. Now, we understand that this independent investigation was conducted by Grant Thornton, which has pegged the adverse financial impact at about 1960 crore rupees, which is very close to the the 1979 crore rupee hit, which was determined by external auditor PwC earlier. The bank will now account for this loss in its fourth quarter earnings. Meanwhile, the Reserve Bank of India has already shortened CEO Sumant Katpalia's tenure to March next year, and as we had reported, asked the board to submit the potential CEO candidate names by October. So the accounting fallout is triggering top-level exits, and this may not be the last one.
Okay, Ritu, thank you so much for that. We'll keep an eye out on more updates that come in from IndusInd Bank. But let's move on and talk about TVS Motors. That has slipped in trade, and this is despite a strong set of numbers that came in Q4 FY25. And this is why, as the management had indicated and indicates some caution on growth. Sudarshan is here to give us more details on what is the highlight he's picking in terms of the management as well as the numbers. Good morning, Sudarshan.
Good morning, Vinay. So I'll divide TVS in two parts. First, talking about the earnings. Earnings were beat than estimates. If you talk about the reported numbers, margin had come in at 14% against our estimate of 13%, but this margin of 14% had included PLI benefits. If you exclude PLI benefits, now the margin was at 12.5%, which was largely in line with all the estimates. Now coming to the commentary, we'll start with the global outlook. Company is saying the major market, that is the African market, that has hit the bottom, and from here on, growth should improve going forward. Now coming to the domestic growth outlook, company is saying that FY26 should be similar to what the industry had seen in FY25. So in FY25, TVS was one of the companies which had outperformed all the other companies. Two major outperformers from two-wheeler space were Eicher Motors and TVS. Now, why the stock is under pressure? The reason is company has cautioned about Q1. It's saying that there might be some moderation in Q1, especially in the month of April, because last year in 2024, April had seen a base effect. But again, here also, it's saying that May and June are going to be strong, considering the number of marriage dates this year is more than what the industry had seen in 2024. Now, another reason of stock being under pressure is the most expensive stock in the two-wheeler space, and results were better than estimates, but due to mixed commentary, you are seeing a fall today.
Thank you very much for that. PNB Housing Finance has posted good numbers. The net interest margin is at a 6-quarter high, and that stock will also come up for you on your screen. It's soaring in trade. Abhishek is here with the details.
Well, all-round performance has been strong from PNB Housing, whether PNL or the business momentum as well. So take a look at net interest margin. It's at 6-quarter high of 3.75% versus 3.7% in the previous quarter. The spreads have declined by 10 basis points quarter-on-quarter to 2.19% versus 2.29% in the previous quarter. Asset quality continues to improve. Gross NPA ratio at 1.08% versus 1.19% in the previous quarter. This 1.08% is perhaps at a 22-quarter low. Disbursements are robust. Growth is over there, 23.7% YOY and about 24.5% sequentially. The disbursements to AUM ratio has improved to close to 52% versus 39% in the previous quarter. So tenure of the book has increased, and that's caused AUM growth to remain on the healthier side when compared to previous quarters. So the AUM growth is close to 12.9% YOY and 4.5% sequentially. YOY, the AUM growth of 12.9% is perhaps at a 21-quarter high. Back to you.
Okay, Abhishek, thank you so much for that. But on that note, we're going to slip into a very short break. And on the other side, we'll be joined by Rishi Gupta, MD and CEO of Fino Payments Bank, to discuss the company's performance in the quarter gone by.
Welcome back. Sterlite Tech is under pressure, down nearly 5%. It's not numbers. Numbers are not, it's not related to numbers, but you can see significant weakness in Sterlite Tech, and that's fallen on pretty large volumes. Shriram Finance is correcting for the second day in a row. Yesterday, stock was down 5%. It's fallen another 1% today. And even L&T Finance is a bit subdued in trade. Castrol deserves mention because it's again falling on pretty large volumes, 2% down on that. On the way up, it's many of your banking names. So a UCO Bank, Equitas Small Finance Bank, Bandhan Bank, AU Small Finance Bank, Punjab and Sindh Bank, Central Bank of India. These are stocks where there are gains anywhere between 2 to 3%. Mazgaon Dock Shipyards has hit a fresh 52-week high. The stock is now inching towards the 3,000 rupee mark. and Samhi Hotels is up nearly about 5%. So Eternal, earlier Zomato, is also one of the big movers today. But let's talk about RBI's unexpected announcement yesterday. They will be buying an eye-popping 1.25 lakh crore of bonds over the next 4 weeks. Lata's here to explain what may have prodded the RBI and what the impact is of this.
Yes, that's right. The Reserve Bank is going to buy 1.25 lakh crore of bonds in 4 tranches from May 6 to May 19. Announcement came late on Monday, surprised the market because already the interbank market has excess liquidity of over 1 lakh crore, and which is why the one-day money, what you call the call rate, is trading below the repo rate because there's excess money. The market has 2 sets of guesses why the Reserve Bank would put more money when there is already money in the system. One is it could be because of the FX positions of the Reserve Bank. They had entered into a lot of buy-sell swaps. The sell leg would be maturing now. The data we have is that as of February, they had $80 billion of sell positions. Maybe 30 to 40 billion is maturing now in April and May. And that's why they're standing prepared with extra liquidity, because when the RBI sells the dollars for the maturity, it pulls back rupees and it may take away rupees. The other guess is that no, there is enough dollars coming in from FPI bond and equity funds to meet that RBI sell. This is because the Reserve Bank is calculating for the year as a whole, the shortfall or the liquidity withdrawal would be to the tune of 4 lakh crore. This is how the math is being worked. Cash withdrawal is always there by you and me during festival season. That is about 2 lakh crore over the year. And another 1 lakh crore is set aside by banks for cash reserve ratio. You know, what is cash reserve ratio? Every time you make a deposit, 4% should be kept as cash. That would take away 1 lakh crore. The other 1 lakh crore is Reserve Bank owns bonds which mature this year. When the bonds mature, the bonds are returned and money comes from the government to the Reserve Bank. So that is liquidity withdrawal. To replenish that, part of this is coming as 1.25 lakh crore. Whatever be the prodding, the impact is that bond yields have fallen by about 7 to 8 basis points today, from 6.4 plus to 6.3334. And banks and NBFCs are having a very good day. And that's because the rate cut transmission is expected to happen very quickly when there is good liquidity.
Okay, Lata, thank you so much for that. But do stay on with us because the Monetary Policy Committee only voted on the rate cut in April and February policies, not on the stance. This was revealed by the external MPC member, Dr. Saugata Bhattacharya, to CNBC-TV18. And we spoke to him today. Lata is joining in with us and she's here to actually explain us and put this into context. What does this mean as well, Lata?
Well, it is not very widely known that the MPC, when it meets every alternate month, votes only on the rate, the repo rate, not on the stance. Because the experience is not very clear. What Saugata Bhattacharya, the external member of the current MPC, told us is that in the current and the February MPC, there was no vote taken on the stance. People were generally asked. The vote was only on the repo rate, which was the action was to cut. Now, what he explained is that under the RBI Act, which was amended in 2015 by the flexible inflation targeting framework, the position was made very clear that whether the repo rate will be hiked or paused or kept unchanged or cut will be taken by the MPC by a vote. It was left at that. Anything else can be put to vote by the chairman of the committee, which is the RBI governor. So mandatorily, the stance need not be put to vote. Dr. Bhattacharya also told us that the experience has been depended on the governor. From 2016, when the MPC first started, to 2018, under Governor Urjit Patel, the stance was not put to vote. Under Shaktikanta Das, from 2018 to 2024, the stance was put to vote. Under the new governor, the opinion is sought, but it is not put to vote under Governor Sanjay Malhotra.
There is no mention of a vote for a stance. There is no mention of a stance. There is that phrase that the chairman of the MPC, which is the governor, the RBI governor, has the right to put in. I'm just paraphrasing. I don't remember the exact wording of the act. That the chairman of the MPC has the right to pull in anything that he or she might deem important at that point in time. Also remember, in terms of history, that the stance, voting on the stance was only introduced in October of 2018, and not before.
Okay, moving on now to corporate earnings. For Fino Payments Bank, Q4 turned out to be a good quarter. Rishi Gupta, Managing Director, CEO, is now with us. Thank you very much, Mr. Gupta, for joining in. So you delivered on your revised guidance of 25%. At the start of the year, it was 20% for FY25. You upped it during the course of the year to 25%, and you managed to deliver on that in terms of a top line. Now for FY26, what are you guiding?
So right now, good morning to all your viewers. So for 24-25, we have said we'll do a 25% growth, and we have been able to achieve that growth for 24-25. For 25-26, we have not put a guidance number right now as such, but looking at the momentum, we see a healthy growth in 25-26 as well, compared to what we happened in 24-25. You also have to factor the fact that the base has also substantially grown in the last couple of years.
So you're not giving a guidance for FY26?
Yeah, right now we are not giving any guidance for 25-26, but we will come back at the appropriate time.
Why? You typically give a guidance. So what's stopping you this time? I understand the base is bigger, but that may affect the growth rate.
So our guidance have been, like we were used to say 20% earlier. In 25, we said 25%. At 25-26, right now we say between 20 to 25% is something which we are looking at. But to get a better exact number, it will take a little bit more time because there's a lot of changes which is happening in the ecosystem as we speak.
Can you talk about that and why you fear that how will that impact the way the growth pans out for the company?
See, we have grown substantially in the last year. We have seen a big growth happening on the digital side as well as on the CASA numbers. And the base itself has grown substantially from our opening numbers in 23 for CASA and 24 for digital. To grow on top of that, we have to add more products, which we are in the process of approvals, as well as some getting rolled out in the next 1 or 2 quarters. So looking at the growth of those products and looking at the approvals which come in our way, that is where we said we need a little bit more time to come at a more firm guidance, so to say.
Right. Good morning, Mr. Gupta. Thank you so much for joining in. This is Vinny this side as well. What I also want to know, there was some persistent weakness that we saw coming in on the micro ATM side, certain issues on remittance business as well. So why is it, still continuing? Do we expect this to still continue in going forward as well? And because we've seen a decline, QOQ, YOY, whatever you compare. So what are we watching out for?
Yeah, you're absolutely right. Actually, as a company, we have moved from a more of physical company to more digital company. Nearly 50% of our revenues are coming from UPI and related digital products. The physical ecosystem has come down in the last couple of years, mainly because of remittance as well as micro ATM. We have also seen a lot of customers who used to come to our platform to do such kind of products have now become our own customers, and we see that revenue shifting from transaction to more ownership revenue, so to say. So part of the shift, which part of the decline is because of the shift of customers from transaction to our own customers. Part of it is also because of the ecosystem change and some regulatory changes which have happened specifically in case of remittance in the last 6 months. So we expect that the numbers of Q4, which is there, largely to be there for the full year as such for 25-26.
Also, just want to understand in terms of your margins, what are we expecting there as well? What is it that we watched out for in terms of Q4? Seems like overall margins somewhere were at 12.95%. From here on in FY26, what could we expect?
So when we look at the net revenue margin, that is something we keep on giving guidance around. It's been around 30 to 33%. And we expect that the net revenue margin will be in the same range. Even for Q4, it is around 31.5. So it's in that range. We'll continue to be that range. Our PAT numbers have been, PBT numbers have been around 6%. And hopefully we'll continue to be in that 6% range. And maybe as we go forward with more of our ownership products, the margin should go up.
Mr.
One
Gupta,
more thing which is important is that in the last couple of years, we have done large capex on the IT side, which has impacted the depreciation as well as the operating cost or the OPEX on the IT. So that is substantially increased in the last 2 years, 3 years. And we expect that momentum to continue because a lot of IT spend is actually being done on the back of the digital growth, which we are seeing.
I think CASA is now, what, 25%?
CASA, if I include the liability income, which is the treasury income on the CASA deposits, is about 30% for the full year and 31% for Q4. And we have seen a substantial jump on the CASA overall revenue by 42% in 25 over 24. And similarly, digital now contributes to nearly 21% of the overall revenue. So between digital and CASA, more than 50% of the revenue is coming in 24-25.
And how will these numbers trend going ahead? So CASA currently is about 30-31% and digital is 24%.
21%.
Sorry, 21%. I know, yeah. So your own expectation on these two?
My own expectation is that between CASA and digital, we should be somewhere between 55 to 60% for the full year in 25-26.
Okay. Mr. Gupta, I just have one doubt is in terms of why have you stopped giving those debit card spend details that we used to see coming in before as well? My colleague has highlighted it, Abhishek. So I just want to know what is it in terms of why is that missing as well as overall in terms of the sustainable run rate for growth in terms of spends also like you were talking about previously. So what is that we could expect in FY26?
So you are absolutely right. In fact, if you look at ecosystem, you look at our own way we deal business, we have stopped using debit cards to a large extent. Everybody has moved to UPI. So if you look at the UPI P2M number, which is just flashing it on your screen right now, we'll see a substantial jump, nearly a 2x number for the full year compared to what was there in 24. So debit cards in particular or in general, the spends have come down. People have moved to UPI now rather than debit card. So debit card volumes have not grown, but the number of cards issued have grown, but the usage has not grown to that extent because of the shift on the consumer behavior from debit cards to UPI. There is no other reason.
Mr. Gupta, we'll leave the conversation here. Thank you very much for joining in, and we'll await that official guidance for you. We're used to those structured numbers, so we'll await that. Thank you very much for joining in. But the company, in a way, is saying 20-25% growth is sort of sustainable. But we'll slip into a break on that note. As we do that, some good news for all our viewers because India's business news leader is now just a click away, introducing CNBC-TV18 all-new app. Get instant access to breaking news, our articles, financial world updates at your fingertips. Don't wait. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you could just scan the QR code on your screen.
Welcome back to Trading Hour on CNBC TV18. Let's shift focus to gold now. We are witnessing a true gold rush, not fueled by inflation, not just by financial markets, but by geopolitics, trust and fear. Why central banks are hoarding on gold? Prashant is joining in with us to explain us that.
Let's take you into a global financial story that's unfolding quietly but powerfully. A new gold rush 2.0, led not by consumers or investors, but by central banks. Why are the world's top and most powerful monetary authorities hoarding gold at record levels? Let's break it down. Let's look at the pace of the rise in gold prices to begin with. Now, the rise in gold prices is not new, but the tempo has shifted. After the US abandoned the gold standard in 1971, it took nearly 38 years for gold prices to hit a $1,000 mark, a milestone finally reached in March of 2008 during the global financial crisis. The next leap was quicker. Gold doubled to $2,000 in 2020, August 2020, fueled by the economic uncertainty of the COVID-19 pandemic. That took 12 years. But the pace has since accelerated dramatically. On March 14, 2025, this year, spot gold prices broke through the $3,000 barrier for the first time. The climb now for the last $500, $25 to $3,000, took just 210 days. A stark contrast to the previous $500 increments, which historically averaged more than 1,700 days. Now, gold's rise is no longer gradual. It's gathering speed. Now, the analysts at JP Morgan have divided the gold era, modern gold era, into three regimes, three periods. Let me put this out. First as a pure inflation hedge from 1970s to 1990, then as a mirror against real US bond yields 2000 to 2021, and now a geopolitical safe haven driven by central banks pivoting away from the US dollar. And of course, I mean, you could add a fourth one. There is Trump driving an American breakup from the rest of the world. Let's take it one by one. The first era, in the 1970s and 80s, gold was all about inflation. When inflation expectations surged, and they surged to 8% in the early 1980s, gold prices exploded eightfold. But once Paul Volcker, the then Fed chair, crushed inflation with aggressive rate increases, gold prices collapsed. Now, from 2000 to 2021, this is the second era, the second regime, survey-based 10-year inflation expectations remain largely anchored between 2 to 2.5%, while real gold prices increased significantly. Now, this was a new dynamic, a newer relationship. Now, the relationship between gold and US treasuries is rooted in the competition between two so-called risk-free assets. Gold, which offers no yield, becomes less attractive when real yields on longer-dated US treasuries rise because the opportunity cost of holding gold increases. Conversely, when real treasury yields fall, gold becomes more appealing, more valuable as a store of value. In the 2 decades starting 2000, gold consistently showed a strong opposite inverse relationship with a 10-year US real treasury yield. And this is the third stage then, the rupture. In 2022, US and its allies froze $300 billion of Russia's foreign reserves. This shocked the world. Suddenly holding dollars or euros or other currencies, paper currency, wasn't just about economics. It carried geopolitical risk. Since then, central banks have turned into super buyers of gold, price insensitive. Price matters little, securities matters a whole lot more. Adding to this, the US under Trump 2.0 has moved towards isolation, America first foreign policy, pulling back from alliances like NATO, the United Nations, the World Trade Organization, and of course, as I described earlier, weaponizing sanctions as well. This has reinforced the instinct amongst many nations to diversify their reserves, and gold is the fallback. The result, a historic buying spree surge. Central banks used to buy around $400 tons of gold per year. In 2022, they bought more than 1,080 tons, the highest on record then, and they kept going. 1,051 tons in 2023, another 1,045 tons in 2024, and this year, 2025, has started no differently. Today, central banks collectively own around 36,000 tons of gold, nearly 18% of the total reserves. That's a sharp jump higher from 15% just a year ago. I mean, 3%, right? But it's happening at the highest levels of global finance. It's meaningful, it's chunky. Meanwhile, you can ask the question, is supply of gold keeping pace? The answer is no. Mining output has been flat since 2018, constrained by falling ore grades, rising extraction costs, and stricter environmental regulations as well. In short, you got demand, which is strong, central banks are big buyers, supply is constrained as well. I mean, just a factoid, right? I mean, interesting factoid, just to remind us that gold is rare and that scarcity drives value as well. If you look at all the gold which has been mined through human history, it's about 2 lakh tons. It's enough to cover a soccer field, but only to a depth of 1 meter. And most of that gold is with us right now. To conclude, what we are witnessing is a true gold rush 2.0, not fueled by just inflation, fiscal deficits, paper currency debasement, etc., but by geopolitics, trust and fear. In a world where financial assets can be frozen overnight, gold once again is the ultimate fallback.
What an interesting link, Prashant. Thank you very much for that, and ending it with that factoid. Now let's get to the big earnings that we're tracking today. So first up, we've got Abhishek joining in with the key expectations from Bajaj Finance. Abhishek.
Well, Bajaj Finance gave out the preliminary numbers with respect to the business momentum, wherein the AUM growth was weakest in 8 quarters on a YOY basis and weakest in 11 quarters on a sequential basis. So key things to watch will be the net interest margin can decline both YOY and quarter-on-quarter. Kotak Securities estimates a 71 basis point YOY and 14 basis point quarter-on-quarter decline in net interest margin. Now, credit costs can decline on a sequential basis as well. Kotak Securities estimates an 18 basis point decline in the credit cost of Bajaj Finance in Q4 FY25. Cost to income ratio can rise marginally but remain stable. So, Kotak Securities again estimates a 16 basis point increase in cost to income ratio. Now, stability in asset quality will be positive. Management commentary with respect to future outlook and guidance for FY26 will be seen closely. Our polls suggest an NII growth of 23.3% YOY and about 5.3% sequentially. We are working with a profit growth of 19.7% YOY and about 6.3% on a sequential basis. Back to you.
Okay, thank you so much for that, Abhishek. But we have Sudarshan who's here to tell us in terms of BPCL, what are they expecting from the Q4 numbers? Sudarshan, over to you.
So earnings for BPCL might be slightly on a weaker side, mainly because of fall in refining and marketing margin. Marketing margin Q4 FY25 has fallen up to ₹4. Now coming to the headline numbers, profit is seen falling 42%. Revenue may be subdued, maybe just see an increase of 1%. EBITDA can fall up to 31% and margin can come below 5%, likely at 4.6% versus 6.7% that company has reported in Q3 of FY25. What about the GRM? GRM may fall YOY, but on a sequential basis, it might be flat. It might come at $5.60 per barrel versus $12.50 per barrel that company had reported in Q4 of FY24. Crude throughput may increase and it might come at 10.4 million tons versus 9.5 million tons reported in the last quarter. What would be looking in the management's commentary? First, what's the on volume front of the two major refineries? And second, what's the update on Nunukan block, because company had announced investment of $121 million. And what's the update on listing of Maharashtra natural gas? And also lastly about the crude sourcing after Russian sanctions.
Thank you very much for that. And Ambuja Cement will report their Q4 numbers. Nigel is with us.
Well, that's right. We'll keep an eye on Ambuja Cements, and what will be new in these numbers will be the standalone part of the business. But most of the street have given the consolidated numbers. Why do I say the standalone numbers will be the new part of the business? Because we already have numbers coming in from ACC as well as Sanghi, which will be incorporated in their consolidated numbers. Nonetheless, in terms of the numbers, the expectations on a consolidated basis, 9,900 crores is what we're looking at in terms of the top line. The EBITDA number should come in at around 1,600 crores ballpark, which on a sequential basis will show a big jump because Q3 was an absolute washout. The margins as well should scale to close to mid-teens. That compares with sub 10% margins that they delivered last time around. The important factors to track, how are the inorganic acquisitions moving around? That's the Sanghi Industry acquisition, the Penna Cement acquisition as well, and what's the path that they're laying out there. The growth on the top line will be led by volumes, and volumes are estimated to grow by around 15 to around 19%, primarily led by inorganic growth. Blended realization should decline on a year-on-year basis, though on a sequential basis will spike up by close to 2 to around 3%. Though the costs will decline. Remember, in Q3, you had a one-off high maintenance cost, which this time around will not be there. The profit number, well, we'll see a bit of a restriction in terms of growth, because there'll be higher depreciation costs. For these companies that have already delivered parts of their business, the commentary is most important. And for Ambuja Cements as well, will be important to hear how they see pricing, demand, as well as how they integrating the inorganic growth. Back to you guys.
Thank you very much for that. And Trent will be the other big one to track today. They've already given a Q4 update where the company has spoken about a 28% top-line growth, which is the lowest analysts point out in the last 16 quarters. And FY25 growth will be about 39%. So we have a sneak peek into what the quarter will look like. But the street will track very closely in terms of the store additions, the guidance on revenues, the extended end-of-season sale, which could impact margins. So lots of details awaited. This is a highly tracked company. The stock is corrected nearly 37% from its 52-week high, and still it's quite expensive at about 70 times forward PE multiple. So Trent is the other big one to track today. Get into a break. We'll come back with more on the markets.
Welcome back to Trading Hour on CNBC-TV18. Now, sources tell CNBC-TV18 that India is considering restricting the export of electronics and e-commerce goods to Pakistan. The move comes against the backdrop of escalating tensions between the two countries. Abhimanyu is joining in with us to give us more details on this front. Abhimanyu?
Sources have indicated that after Indus Water, Indian electronics and e-commerce goods may face curbs for Pakistan because after passenger traffic, there is a likelihood that air cargo route over Pakistan may get severely impacted. Sources have indicated that the government is collating data from the Customs Department and several other departments to understand the logistics cost for exporters in case of any further disruptions. Also, plans are underway to assess the impact of trade to UAE and Europe as part of multifaceted preparations for a possible disruption which may happen for trade. Also, sources explained that direct trade between India and Pakistan is minuscule as most Indian goods are re-exported via third countries to Pakistan, and the third countries include nations like the UAE, Sri Lanka and Singapore, and it's primarily items like gold, gems and jewelry, electronics and e-commerce goods which are re-exported to Pakistan via these countries. Now, as per GTRI, Indian goods worth over $10 billion per year reach Pakistan from these third countries, which may face fresh curbs based on the assessment which is underway. It remains to be seen what happens with respect to the assessment, and based on the stakeholder consultation, based on the information which reaches the government from various departments, any further action would be initiated.
Thank you very much for that. As we wrap up the show, here is some good news. Network 18 is the leader in the news information category in the on-platform leadership network level, with 183.2 million unique views, beating Times Internet as per ComScore MMX report as of March 2025 at the Social Plus on-platform leadership network level. Network 18 is the runaway leader as per Social Plus MMX ComScore report for March 2025 with 315 million unique views, which is 55% more than the nearest competitor Times Internet at 202 million. News 18 was also races ahead of Times of India. In terms of Social Plus MMX cumulative reach, News18.com overall clocked about 255 million unique views to beat Times of India overall, with 183 million unique views as per the ComScore report. This is all as per March 2025. As per the social media metrics report, Network 18 is 2 times bigger than its nearest competitor, with a 54% reach within the 389 million overall social population. And speaking about Indian languages in terms of Social Plus MMX, the cumulative reach of News 18 Indian languages is the leader in the category with 182 million unique views as per the Comms report.